I think it is the most important because it's very much at the center of the discussion around what's going on in the Treasury market this week. And when you think about the underlying fundamentals of the economy, 6.5% year-over-year growth in nominal GDP is, I think a very indicative, of course, of what we're seeing in terms of the AI boom. But I think also in the context of inflation as well, you can't really get inflation down to 2% unless you see sort of the greatest productivity boom ever. So it's not a bad thing. I don't mean that in a bad way, but I think that to the point of this sort of booming economy and the resilience that we see in the U.S., we have sort of entered this new normal where it's now more normal to see nominal growth of that kind versus what we saw pre-pandemic, which was much slower than 6.5%.
I want to talk about the bond market because Tom and I earlier in the show, we said that is the big story of this week. What did the market learn from the bond moves and the Bessent put, so to speak, and its rapid reversal? Is it that they're skeptical about this move? I mean, many people have called it the Band-Aid, just a Band-Aid, really. But
no, I mean, I think that's probably the right way to think about it. The sort of duct tape on a leaky pipe situation where that can only last for so long in terms of stemming some of the drippage there. But I think that the whole discussion around higher deficits and the fact that no one's really doing anything about it on either side of the aisle, that's been a theme and a feature of the U.S. for so long. But that in combination with this structurally higher growth backdrop that we've been in, plus the fact that you have stickier inflation, all of these elements fuse together and you get a higher for longer interest rate world, and it's very, very hard to pull down yields in that environment, especially, of course, at the long end. You also introduce, I think, another interesting dynamic, which, I mean, to be a fly on the wall right now for any of the Fed meetings and discussions, it would be so fascinating because you do have a little bit of this vicious circle dynamic at play where on the one hand, someone is sort of actively trying to pull down yields or do what they can to stem the rise. But on the other hand, you did have Fed Chair Kevin Warsh sort of take some comfort in the fact that the long end had risen and it was sort of, quote, doing the Fed's job for it. So that dynamic, I think, it'll be interesting to see if he addresses it at all in Jackson Hole. But I think over the medium term to see how those kind of combat each other, that'll be interesting to me.
I would love to go to Jackson Hole and wear a Jackson Hole outfit. Beautiful. I love having you because then you can talk all asset classes. Why didn't stocks respond more to Washington signaling that it wants easier financial conditions?
Well, I think, in terms, as powerful as signaling might be, and we've learned that, over the past couple of days, it isn't as powerful because of the reversal that we saw in yields. We've been in this environment and we don't have too much high conviction these days because it's really hard to do so. But where we do have higher conviction is the fact that or the feeling that we have sort of exited definitively this great moderation era where you had this harmonious relationship between the stock market and the bond market where when yields were going up, they were responding to positive growth impulses, stocks were also rising. Post-pandemic, for most of that time, most of this cycle, that relationship has flipped into negative territory. So that means that all else equal, which is of course never the case, but when yields are rising, that's putting downward pressure on equities and then vice versa. And you've seen that play out this week almost. And it's happening again today. If yields are up, stocks are down, vice versa. So that's not to say that if yields continue to go higher a year from now, that the stock market will be lower. That's certainly not the case. If anything, when you get these more aggressive moves in yields, that's when you sort of have that reset period for stocks.
Across America on this Friday, Kevin Gordon with us. He is with Charles Schwab. Yeoman's duty, reappearing today. He's taking the Sikorsky, reappearing. 12 noon, Bloomberg Money.
Really?
Yeah.
I have to tune in.
Oh my
Folks,
gosh.
I got ducky bumps over It's Sleepy August. No, it's not. Rebecca Patterson into Kevin Gordon.
Big names. Can't get any better.
And we're doing books on Paris because everyone's there except me and Scarlett.
And me.
And so, we're not in Paris. We should be in Paris.
We should be in Paris.
Kevin, I want to remind ourselves, and Emily Rowland coming up, folks. It's a Friday. We're going to brief you on the madness at hand. Can we recall that Broadcom has free cash flow growth coming out of the COVID 16, 17, 19, 26, 32, and an anticipated $50 billion of free cash flow? The heart of the matter is we forget these are profitable juggernauts we're whining about.
Yeah, no, the profitability aspect I think is huge, and it is one of the biggest things we point to, especially when we get questions, because we still get a lot of client questions around this, I think rightly so, is this a repeat of what we saw in the 90s? And I know this has sort of been, beaten a lot, but I think it's important because when you do look at the factor in the equity market that was most correlated with strong performance in the late 90s into the peak, it was negative earnings. That is not the case today. So I think that's a really important differential. Not to say that you can't have disruptions and you can't go through these, sort of momentum implosions like we did recently, but that, I think, for the broader structure of the equity market is much more important, especially in a context of an S&P 500 that has more than 70% of its members above their 200-day moving average.
You get on the Schwab Gulf Stream, you go down to Louisville, you're in some hotel room with 400 major Schwab hitters. In the 15th row, someone raises their hand and goes, "What do we do with cash?" It vibrates across America right now.
Yes.
What to do with cash?
Well, full disclosure, there's no Gulf Stream in my life, very much in the commercial world. So I want to say that.
Liz Ann's.
But the cash question, we get so much. I think more in the context, and I know you've covered this recently in conversations with Lizanne, but the cash question we get is sort of what is the potential for that firepower for the market? And I mean, we've looked at this so many ways, but when you do look at it relative to market cap, the total cash position today is quite small relative to history. In terms of allocating that cash and where to put it, I mean, we can't answer that question in a broad sense because we have, tens of millions of clients. But if you're thinking about, the sort of how the market has looked this year and the fact that it is not just the mega cap AI trade that is outperforming. There are other parts of the market that are participating, some of which had been sort of asleep for years. I point to small caps as an example. Not to say that you should just back up the truck and load everything into small caps, but that is an example, I think, of how you don't necessarily need to be so singular focused in terms of, it's only the mega caps. That really isn't the case, hasn't been the case for a couple of years, actually, in terms of outperformance. There have been other parts of the market that have performed well.
I want to go to the economy. You argue that the July jobs and retail sales numbers are false positives. What's one data point you're watching that you think may prove you wrong?
Well, I do think that I think that for labor, I'll start with that. There's not a whole lot, I think, that is pointing to and is supporting this kind of outright weakness that you saw in July. And I do think that in an environment where we have constrained immigration flow and an aging workforce, it makes the labor dynamics a little bit harder to see and harder to read in a standard, non-farm payrolls report. Meaning, last fall into the winter, when you did go through that significant slowdown in payroll growth, when everybody was sort of starting to raise those yellow flags around recession risk, because that's typically what you see going into a recession. If you were looking at the layoff data, that's actually what was the more important signal. So to me, jobless claims have been the best labor indicator in this post-pandemic cycle because even though we've gone through this low hiring cycle, hiring rate plunged, came down to, more than a decade low. You didn't have the response that you would typically see on the layoff side. So to me, that's why the labor stuff, at least from a non-farm payroll sense, has been a little bit of that false positive. Because if you do strip out, what happened with local government, if you strip out what happened with the World Cup kind of hangover effect, you were still net positive on payrolls in July. It wasn't great, but we also probably have a lower break-even rate at this point.
Futures up 24 right now. Dow futures up 200. NASDAQ lifts 0.6%. The VIX up to 16, comes back down mid-range for the week, 15.67. The Bessent yield, I'm starting to call it that, 5.25%, fractionally elevated. Still some real stress there in a 30-year bond, 5.25%. We're going to rip up the script right now. We do that with Isabel Lee in the studio, with Kevin Gordon. In Denmark, a gallon in U.S. dollars of diesel in Copenhagen approaches $10 a gallon.
Wow.
In Berlin, $8. Madrid, $8. In the Philippines, 98% of their petroleum is imported. And they're popping nothing like $10 a gallon U.S. dollars.
And the minimum wage back home is $10 a day.
Okay.
FYI.
Perfectly said. But Kevin, talk about the Brent crude or the gallon of gas here, $94.07 on Brent. To the third world, to the Pacific Rim, the distillate effect here is just immense.
I know. I think when you talk about the Philippines, Isabel and I talk about sort of our home countries a lot. I think about Korea having that import bias too. I mean, it is amazing. I think the disconnect in terms of what we feel here in the West, especially being in a country where we're a lot more insulated in terms of oil production versus having that dependence. So the longer this conflict persists, you do raise that question again of the difference between price increases being your biggest problem, which is clearly the case in a country like the U.S., versus actual oil and energy sort of physical, shortages. That's the difference that you're sort of dealing with. But even in the U.S., you sort of have to. I had put a chart out on Twitter yesterday where the rolling correlation between yields and oil prices has approached almost an all-time high. And the longer that you see gasoline prices sort of rise and stay higher, that acts as ultimately, the consumer will start to treat that as a permanent pinch.
I got the prices here, $5.45 in Manila, outside of Makati. They don't sell diesel in Makati. And in Seoul, Korea, it's $5.30. Those are low numbers, but as you say, Isabel, these are nations with a complete reset on what the wages, you said $10 a day.
It's really, honestly, very hard. In the Philippines, they've imposed a lot of work from home because people just can't afford to go to work.
They literally can't afford the gas to go to work.
Newsflash, internet there is so slow, it'll take you a whole day to download Netflix.
The highway there is called the EDSA. Am I right on that? EDSA?
Tom, you should visit.
It's packed, right?
Plus, they do more rolling blackouts there, too. So there's a lot more energy disruption.
Look at you. Both of you should come with me. I'm going in October.
Let's go,
Tom. Okay, but Tom only travels first class. I'm sorry, I don't do that.
We could remote from the peninsula. Right? We could do a thing for the Peninsula Hotel. Right by the Ayala Triangle. Is that what it's called?
Very good.
I nailed that?
Yes, you definitely did.
Bring Schwab along with us as well?
Yes, conduct a field study.
But folks, I think this is really, really important in that there's more going on here than just what a gallon of gas is at the Wawa.
Yes.
Distillates and refineries. It's a huge impact.
It is a huge impact. I think that, and clearly the big wild card in all of this has been China over the past several months. The import activity and sort of the collapse that you've seen and the plunge in import activity. So all it really takes is, China sort of flip that back on, and to see what they do with that, I think will be crucial in terms of the oil market for the rest of the year, because that does have a potential to sort of be this really big swing factor when it comes to prices again.